All right, welcome to the Explainer. Today we are diving deep into what is, let's be honest, one of the most complex areas of the tax code, the passive activity loss rules. If you've ever dealt with rental properties or businesses where you're not involved day to day, you know this stuff can be a real headache. So we're going to deconstruct how these suspended losses work and, more importantly, how you can finally unlock their value. Let's jump in. Okay, right off the bat, let's nail down the single most important concept. Section 469 is all about timing. Unlike other rules that might permanently kill a deduction, this section doesn't disallow your loss forever. It just suspends it. Think of it like the tax code putting that loss in a penalty box. As Section 469B points out, that loss gets carried forward, just waiting for the right moment to get back in the game in a future year. So here's our game plan. We'll start with the basics of the suspension regime. Then we'll get into a critical first step, defining what an economic unit or activity even is. After that, we'll tackle the all-important material participation tests, touch on some special rules, and then get to the part everyone's waiting for, how to actually unlock those suspended losses. Finally, we'll see how it all comes together on Form 8582. Right, so let's dig into that core principle. Why did Congress even create Section 469? Well, the goal was pretty specific: to stop taxpayers from using losses from passive investments, think tax shelters, to artificially lower the taxes on their active income, like their salaries or their portfolio income from stocks and bonds. So what exactly is a passive activity loss, or a PAL? It's simple, really. It happens when your deductions from all your passive activities are more than the income you made from them. And Section 469A lays down the law. You cannot take that net loss and use it to reduce your other income for the year, period. Passive losses can only offset passive income. Anything left over, it gets punted to next year as a suspended loss. Okay, so before we can even think about applying these rules, we have to tackle a really fundamental question. What exactly is the activity? The entire analysis, everything that comes after, hinges on this one definition, which is all laid out for us in Treasury Regulation Section 1.469-4. Now, the regulations don't just hand you a neat little checklist. Instead, they give us a facts and circumstances test. The whole idea is to group different ventures together if they really operate as a cohesive economic unit. You know, if you have a bakery and a coffee shop next door that you run as one business, you'd likely group them. It's all about looking at the economic reality, not just the legal paperwork. And listen, this grouping decision, it's a really big deal. You have to get it right from the get-go, because once you make that choice, you're pretty much locked in for future years. And pay close attention to that rule there from Reg 1.469-4D5. If you're a partner or an S-Corp shareholder, the entity makes the grouping decision first, and you are bound by it. You can't just undo it on your personal return. This initial choice sets off a chain reaction for everything else. All right, so we've defined our activities. What's next? Well, now we hit the absolute heart of the matter. Do you materially participate? This is the golden key. It's the gateway out of the passive loss maze. If you can prove you materially participate, then that activity is considered non-passive, and its losses are no longer trapped by these rules. So how do you prove it? Well, the Treasury Regulations, specifically in Section 1.469-5T, actually give us 7 distinct objective tests to work with. And the best part for taxpayers is you only have to meet one of them. Just one is enough to classify the activity as non-passive for the year. So where did these 7 tests even come from? Well, you have to go back to the actual law, to Internal Revenue Code Section 469H1. The statute itself just gives us this really broad, kind of vague standard. Your involvement has to be regular, continuous, and substantial. What does that even mean? To clarify it, the Treasury stepped in and created those 7 quantitative tests to give us concrete ways to prove we've met that standard. Okay, so out of those 7 tests, these 3 are the ones you'll see most often. They're kind of the big hitters. The first one, more than 500 hours, is the absolute gold standard. If you hit that, you're in. The second one is for situations where maybe you didn't work a ton, but you did basically everything yourself. And that third one, that's for when you put in over 100 hours and you also did more work than anybody else involved. This brings us to a really important concept, something called a significant participation activity, or a SPA for short. So an activity becomes a SPA if you spend more than 100 hours on it, but not enough to meet any of the other material participation tests on its own. Now, why does this matter? Because of the fourth test, which lets you add up all your hours from all your different spas. If that total number goes over 500, boom, you're treated as materially participating in all of them. Now, here's where it gets really technical, a real inside baseball point from a recent IRS technical advice memorandum. Let's say you have an activity, and it helps you meet the material participation standard through that aggregate SPAY test for 5 of the last 10 years. So what happens in year 11? Is it still a SPAY? The IRS says no. In year 11, it now meets the 5 out of 10 year look-back test all by itself. And since the definition of a SPAY is an activity that does not meet any other test, it can no longer be a SPAY for that year. It's a very subtle but super important distinction. As you know, the tax code is never simple, right? It's filled with all these special rules and exceptions, and they're usually there to handle weird situations or to make sure the tax result actually matches what's happening in the real world. And the passive activity rules have their fair share. Let's walk through a classic example of this, the self-charged interest trap. Imagine you loan your own S corporation some money. The S corp pays you interest. To you, that's portfolio income, which is taxable. But for the S corp, it's a business expense. Your share of that expense flows through to you as a passive deduction. So what's the result? You're paying tax on the income, while the loss that should offset it gets suspended. It's a terrible mismatch. So how does the IRS fix this obvious mismatch? Well, thankfully, they came up with a pretty elegant solution in Regulation Section 1.469-7. It's called the self-charged interest rule. It lets you recharacterize or relabel just enough of that portfolio interest income as passive income so that it perfectly cancels out the passive deduction coming from the S corp. It just makes the tax treatment line up with the economic reality that you're just paying yourself. Okay. I cannot stress this next point enough. For any tax pros out there, this is absolutely fundamental: the order of operations. The passive loss rules under Section 469 do not get the first bite of the apple. First, any loss has to make it past the basis limitations. That's Section 704D for partnerships or 1366D for S corps. Then, whatever's left has to clear the at-risk limitations under Section 465. Only the loss that survives both of those hurdles even gets tested under the passive activity rules. We have spent all this time talking about how losses get trapped, how they get suspended. Now for the good part, how do we get them out? How do you finally get to use those valuable deductions against all your other income? The number one way, the ultimate trigger, is when you sell the thing, a fully taxable disposition of your entire interest in the activity to someone who is not related to you. Section 469G makes it clear. This event blows the doors wide open. All of the current year losses and all of the suspended losses from prior years for that activity are released, and you can use them against any kind of income, active portfolio, you name it. But notice that important detail. This is for losses. Suspended tax credits don't get the same treatment. They're still stuck. And here's another one of those crucial ordering rules that can have a huge impact on tax planning. When you finally release those suspended PALs, they jump to the front of the line. You apply them against your other income before you use any net operating loss or NOL carryovers. This is a big deal because a huge release of passive losses could actually create or increase your NOL for the year, which you can then carry to other tax years. Okay, so we've covered the theory, the code sections, the regulations. Let's bring it all home and see how this actually works on paper, on the tax return itself. Let's deconstruct Form 8582, the Passive Activity Loss Limitations Form. This form, this is the battlefield. This is where it all comes together. You take all your passive income, all your passive losses, and all those suspended loss carry-forwards from prior years, and you throw them into the calculation on this form. The final number tells you exactly how much passive loss you can actually deduct this year and how much you've got to carry forward to the next. But here's a really critical mechanical detail about this form. It doesn't just give you a single lump sum for your suspended loss. No, that would be too easy. Instead, its worksheets force you to do something very important. You have to allocate that total disallowed loss back to each specific activity that actually had a loss on a pro-rata basis. This is so important for good record keeping, because when you eventually go to sell one of those activities, you need to know exactly how much suspended loss is attached to it. And that really brings us to the big picture, the ultimate strategic question you should be asking. Since these passive losses can be carried forward forever, waiting for that final sale, it really forces us to think way beyond just this year's tax return. So what is the long-term plan? When and how are we going to unlock the value of these suspended losses for our client? Answering that question is what separates basic compliance from true high-value tax advising.